crises are a good opportunity sometimes to change the balance of power between startups and investors. 2021, full height of COVID, big excesses the other way with very large rounds being done very quickly and with very little due diligence. So I think it's healthy in general to have these cycles. It resets expectations on both sides. But when you go through them, it can feel very daunting and scary.
Hi, and welcome to the June podcast. I'm your host, Enzo, co-founder at June. In this show, I'm talking to the most inspiring product and growth leaders out there who will share their tips on how to launch and grow your SaaS. No fuss, no BS. I hope you enjoyed the show. Hi, Renaud, and welcome to the podcast. How are things?
Hi, Enzo. Doing well, thank you.
Yeah, thank you. Great to have you here. I'm really excited to have you here and chat about entrepreneurship, startups, and how you navigated that crazy journey. So about your journey, you started your career as an environmental engineer, cleaning up the polluted sites at Geometrics. Then you led engineering at Zing Network, a photo sharing app on the web, back to when the best digital camera had only 3 megapixels. After that, you co-founded Eventbrite, which you led to the IPO in 2018. You operated there as the CTO and the co-founder for 16 years, which I think is absolutely insane. I have many questions for you there. And then when you're not writing code, you're mentoring and investing in startups in several European countries. You worked as a venture partner at Index in 2017, and you're now a VP at Point9, who, funny enough, led our seed round 2 years ago.
Coincidence.
Yeah, and that's also how you and we met at a wonderful retreat that they organized. And you're also an active angel investor that have invested in more than 75 startups. And for some of these startups, you are a non-executive board director. You are also, you just told me, working on your own fund, which is in the climate change industry. So Renaud.
Great summary, thank you.
Welcome to the show, and really amazing track record. How do you think about your career so far? Are you kind of like proud? Do you kind of look forward for the next steps? What's on your mind these days?
Yeah, I mean, always proud to have started a company, mostly because we're in the space of physical connections. That's what motivated me in the first place to join my co-founders at Eventbrite, build a product that is not just a virtual product, but brings people together in real life. And after the COVID episode, I think we can all have a different appreciation for these moments of conviviality and connections. So very proud of that fact, very proud of all the things I've learned building a company from nothing to post-IPO and through a global crisis like we had to go through with COVID, and excited about my next journey as an investor.
It's very impressive when I look at your track record, the number of years you spent with Eventbrite. And, I've been like myself only a couple of years in the kind of the entrepreneurial game. And I can really tell it's exhausting. So I'd love to use that experience to channel some of the questions I have for you. And let's start with the crisis. So you've seen 2 crises, right? You've seen at least 2 big tech crises. You've seen the dot-com bubble when you were at Zing Network. So back then you grew the company to 120 people, I think I read, and then had to scale it back to 10-ish people. And then
to kill the company eventually.
And eventually to kill the company. I heard also that you sold some of the code to Sony, right? And you were working with them. Yeah. So I hope maybe there are some, outcome there. And next piece was, of course, the COVID crisis at Eventbrite. So I'd love to...
We also had the financial crisis in 2008, 2009.
Right. Okay, so you went through 3 crises, right? So the dot-com, the 2008 subprime crisis, and the last one with the COVID crisis. Is there any pattern, anything you learned that repeated across this crisis?
Well, maybe the greatest lesson is what doesn't kill you makes you stronger. I think they were all very different. Dot-com crisis was very much an industry trying to figure itself out. And I think the metrics at the time were just not the right ones. It was all about eyeballs and getting attention from the public. But Zing, the photo sharing company that I joined, had a great product. People were putting massively all their photos to the side. They were buying a few products out of these photos. And the whole business model was based on how many of these products people were going to order. But the cost of storage was very expensive at the time. we had to buy the multi-million dollar equipment for storage of the photos, which were very small files at the time, but still added up to very large storage needs that were not like today, where it's a few pennies per file. It was much more expensive than that. And if you don't have the business model to finance this type of investments, then you crash. And that's what happened to us. We raised, I think, 50 million at the time, spent it all on marketing, trying to attract these eyeballs that next week we're going to do the IPO. We have enough visibility now and enough viewers that it's going to work. So a little bit of delusion, I think, on the management side, the company, and just some poor execution in the end that made the company fail. I was just along for the ride. Like, I was a junior engineer because I switched from civil engineering to software engineer at that startup. But a great lesson nonetheless for the years later when we had the other two crises, which were definitely not of our doing, had nothing to do with our business, but came along and made things a lot more complicated for us. And I think both times we were close to dying. So in 2008, 2009, when the financial crisis happened, we were wanting to raise our Series A. We had fairly good metrics, good traction. People were going to events. We had found our business model. We were charging commissions on ticket sales. We had a strong team, maybe fairly early in our revenue curve, but still decent traction in 2007. I think we would have had no problem raising. But when we hit the road in 2008, and after Sequoia published their Rest in Peace Good Times famous deck, I would say, which pretty much stopped all venture investing for quite a while, it became very difficult for us to raise that money. So we managed to find a few supporters, do a 1 million bridge round, survived until the end of 2009, when then we were able to raise from Sequoia. So closing the loop with their famous deck at the beginning of 2008 to closing an A round with them in 2009. COVID was an entirely different ballgame. Global pandemic, all events shut down or postponed or canceled. We advance money to event organizers. So as ticket sales come in, we give some of that money to them. And it happened that when in April 2020, right after everything started shutting down, we had about more than 300 million of advances in the hands of our event organizers. A big liability. Not enough cash to cover that. A lot of scrambling to figure out, first of all, how do we survive as a structure? What needs to happen to be on the path to survivability, I would say? How do we cover this 300 million? What type of tools do our organizers need to deal with the crisis? Because they're all like mini businesses for the most part. And they were also at risk of not surviving the crisis. So we did a lot for them to try to guide them towards the best help, and built a lot of tooling for them to manage either refunds or credits or postponements, all the things they had to do. Eventually, we survived, managed to raise some debt along the way, had to shrink the team by about 45%, but it was maybe a healthy reset in a way, in that we're much stronger today. I left the company in 2021, but follow along, of course, and read all the earnings report and all that. So I'm pretty confident we're a much stronger company as a result of COVID today.
That is like some crazy stories. I really wonder what's happening behind the scenes. When you said that it was hard to raise in 2007 and then in 2008 happened, like what exactly happened here? Is it that everyone was waiting for the cash flow to fuel again the industry, and everyone was in the starting block, and you wait an extra year trying to survive and make your economics better, and then eventually the money comes back? Or do you use that time to build in the relationship? The COVID crisis was a bit different, obviously, because like the world was on pause, but there were some like online businesses that were taking off because of COVID, like Zoom. We just talked about Zoom before this call. So what's really happening there? Do you wait? Do you build this relationship with people? Do you try to pivot the business? For the people that are listening and are currently going through the crisis we're going through, what does it entail, for them?
Well, I think we're still going through a crisis right now. So a lot of startups that are listening will probably relate to that. Money is not as abundant and free-flowing as it was 2 years ago. COVID created maybe the illusion that digital was going to roll over the world and any businesses were worth investing in. There tends to be a herd effect in this venture in general. So funds following each other in dictating market conditions and using sometimes excuses, I think, for not investing. It's to the advantage of the venture industry to have lower prices and less competition and et cetera, et cetera. So I think these crises are a good opportunity sometimes to change the balance of power between startups and investors. 2021, full height of COVID, big excesses the other way with very large rounds being done very quickly and with very little due diligence. So I think it's healthy in general to have these cycles. It resets expectations on both sides. But when you go through them, it can feel very daunting and scary, of course, when you see you have only a few months of runway and you have a certain burn that makes you project that you're going to hit the wall at some point. Yes, it's definitely stressful. So I think one lesson is like, the main reasons why startups fail is because they run out of cash. It's that simple. You don't plan ahead well enough, or you think the train is going to be pausing somewhere and you're going to refuel, but the refuel doesn't come and then you're dead in your tracks. So have enough money in the bank, take the measures that you need to take way ahead of when you think you need to make them. I think cutting costs, for example, in the last year has been the main topic for many startups that either hired too early, too fast, and didn't have enough runway to see through the crisis, because that's really what you need to go through. You need to buckle up and shrink your footprint until you can come safely to the other side and either raise money again or be on the path to profitability, which I think a lot of businesses are opting in at the moment for. Makes you all more attractive to the next investors who will take the risk. But I think it's very cyclical. These short duration, 1 or 2, 3 years, maybe periods where everybody stops, resets, and then we come out with different terms at the end.
And one of the hardest things you touched on is figuring out the end of this period, right? Because one thing that you folks did at Eventbrite was to make a decision on whether or not the future would be digital or if people would want to come back to their normal life, quote. Because they were going to miss it, right? And so you had basically two options, right? Go it full on digital and maybe building even your online platform, or mitigating for that current situation and waiting for the traditional world to be back. And I think you made the bet of the traditional world to be back, correct?
Well, I think we took the middle road of building enough to be compelling still as a destination during the online-only period. So we built a lot of functionality, for example, to integrate with Zoom so that you could still host online events fairly easily, I would say, and continue using the platform. What we didn't want is abandon our customers who needed to switch all their operations to being online. So we did provide a lot of tools for them to do that, but betting that long term it would play out, that physical events would come back in a much bigger way even than before the pandemic. So that was a tough decision when you're in the moment and you don't know when the crisis will end. It could have gone much worse with being more lethal and events not coming back for 10 years. I don't know, I'm making it up. We didn't know whether we could have vaccines that would make gathering thousands of people in the same place safe again. So when you have this pressure and uncertainty about the future, then you make the best educated guess you can make. And the one we made was that there was a physical component to events that would not disappear because it's one of our basic needs, connect with others. And the online experience just doesn't provide the same type of connectivity and relating to the other than physical events provide. So that was our hypothesis. I think we were proved wrong by a few outcomes recently of some of the COVID darlings, I would say, came back to us in a big way. And for us, it's now business as usual, I would say, and going back to our customers, understanding what they need in this new world, maybe a bit more of a mix between online and physical, but with a bigger component of physical events, which can last much longer or much more entertaining when you're live with a different person, and just more effective as a way to communicate.
That was a brilliant. It's very exciting to see how you guys thought about this one, because like mitigating the current situation, trying to bake that into the vision you had at the time, and just making educated guess. I think that's was not an easy moment, and I think you guys navigated that very successfully. So yeah, well done.
We tried our best. We had the few other crises to help us make the right decision, I think, in the end. But yeah, in the moment, it's you ask yourself a lot of questions.
So that's one of the big challenges that the company had, and some of the biggest challenges you had maybe throughout your career. But I'd love to go back to the beginning. I think you have such a unique view on what a business is at the beginning with Eventbrite and through all the startups you advise and the startups you see with your VP current role and so on. Going back to the beginning of Eventbrite, I saw that you started the company with Kevin and Julia, right? Back then?
Mm-hmm. Yeah.
And on top of the PayPal API. So you guys really started, kind of startup studio mode from an API and from kind of an opportunity, right? How do you think about where great ideas are coming from? Is it, from a technology, from an intuition, from a problem understanding, from a mix of all of those?
I think it's a mix of all of these. Kevin was an early investor in PayPal because he went to school at Stanford when the PayPal founders were there. So he got connected to them, put a little money in it, and became this big success. So when he decided to become an entrepreneur, he looked around at how payments were going to evolve over time. And I think the main beauty of PayPal at the time was that you could send money to anyone with just an email address. So the PayPal API was just a wrapper around that made it very easy for anyone to take money from point A to point B. And it definitely went into startup studio mode, thinking about all the potential usage that this PayPal API or this capability really of sending money from one person to the other seamlessly could be useful. So he started Zoom right before Eventbrite, which was not with a Z, but with an X. It was money remittance to certain countries, the basic application of sending money from point A to point B with the complexity of the country in point B being, I can't remember which they started with, but Philippines or India. And it had to be physical. So they were doing the last mile delivery of the money to the physical person. And he built a few prototypes like this at the time. And one became Eventbrite, and that's when I joined them, when he left Zoom and decided to focus on the event business, which also was very poorly served by technology, especially the payments. So what we built was ticket sales that would go directly into the PayPal account of the event organizer. And nobody was doing that at the time. So access to capital for people who organize events is critical. They need to book the venue, the catering, the artists, the team that's going to work on the events. So it was a key differentiator for us. And even the large events didn't really have that. They had money sent to them regularly, maybe on a weekly or monthly basis. But most of the small events had to wait until several days or even weeks after the event to get their cash. So that's the type of disruption. It's, I would say, a business model disruption or capabilities disruption. It takes something from some invention somewhere and applies it to a different field. That's what we did very well. And this happens all the time when a large company creates something that becomes applicable and useful for another field. If you have that creativity of putting one and one together to equal three, then you potentially have a great startup idea.
And was it a very thoughtful process? Like, you guys we have this technology, where can we apply it? And then like option A, option 2, option 3, and then for each option, like consulting work? Or was it just like super intuitive, like, whoa, look.
Okay, Kevin did that before I joined. He did Zoom, and the prototype for Eventbrite were created 5 years before I joined because he dedicated his time on Zoom for a few years. So that's exactly the type of exercise he did. We looked at who needs money from point A to point B, what industries, which ones are totally not served by technology at the moment, and where can we provide a 10 times better experience if we build this API into a full. I think it's a great way to go. I see a lot of this type of thinking in climate tech today, which I get. We can get to that later, but A lot of people going through the list of all the potential climate mitigation solutions and systematically going after how much would it cost? Can I build a company in that space? Is the market ready for it? And then going startup studio mode and putting together teams that actually go after the large opportunity. So I think it's a great way to find your next chapter if you're a founder looking for your second founding company or an exec wanting to start your own business.
And obviously, there are some counter examples, right? If you think about AI, a lot of people jump on solutioning with AI and then kind of like have to, go backward to try to figure out what exactly they're solving. So what are kind of do you have any thresholds or rules of thumb that you apply to make sure that the technology that people apply to an industry makes sense?
Well, my biggest filter, and I apply to a lot of the blockchain projects, for example, is do they talk more about the technology or the business case? And if they talk more about the technology in their pitch, usually it's more of a red flag to me. If you focus your pitch on we're an AI company and then everybody's an AI company at this point, you gotta create a product that people want to use. And that's a very different ballgame, and doesn't matter really what technology you use in the backend. There needs to be a pain point problem that use solution, which is usually a complex building of different technologies together, bundling, then that's a more appealing business to me when there's a clear problem rather than we're going to be using blockchain for X.
Interesting. And so also the 10x framework is really the framework you have in mind. It needs to be 10x better with AI or 10x better with the technology they use.
I think if you're going to incur a lot of cost along the way, then yes, it needs to be 10 times better than the existing. AI is not cheap. You have to have very expensive teams and very expensive computing capabilities. So you got to make sure that whatever the product you're creating is at least an order of magnitude bigger than what's on the market today.
Yeah, totally agree. And so I'd love to tie this point with an early touch point you said. You mentioned that when you started this picture company, it was very expensive to store data, right? And now there is this kind of belief that building product is cheaper, but at the same time, if you look at AI technologies, it can be really pricey, including at scale, right? So there are even some people that argue, like we had the Ryan Singer on this podcast, that it's never been that expensive to build software. Not because the storage is more expensive, but just because the bar is increasing, right? So how do you think about this one? Do you think like the bar keeps increasing and somehow it's more and more expensive to make these things happen and we always need to be careful about the runway? Do you think it's kind of a bit cheaper today to build and, there has never been so many opportunities?
I think it all depends what you build. If you're a consumer mobile app, it's probably quite easy today to build, and there's a lot of frameworks and even WYSIWYG tools to help you build that. If you build a very complex AI-based algorithm that's, does a lot of data crunching on petabytes of data, then it's probably a lot more expensive. So I don't think there's a lot more frameworks. When we started, there was no real framework that you could use to create a website. Mobile wasn't a thing, so we didn't have to worry about it. I would say the specialization is much more needed today than it used to be. We had a lot more people, generalists, who could do everything, versus now that all the different frameworks and stacks require some specialization to be efficient in them. So it's a bit more complicated, I would say, to get a full product offering out the door, mostly because you need multiple devices and you have this complexity of having fairly powerful but complex frameworks to put together, plus all the microservices and API standards that we didn't have at the time. Our first app was just one file that ran on the same server as the database on a physical server in a drawer somewhere. So that was very simple. Now, even with AWS, it's not as simple, I would say. But there's much more power in in the cloud services, for example, that make it a bit faster, as I said, to go to market. I think it's a mix. Some things are easier. You still need very talented people who cost a lot of money to build anything. So I think that has the requirements for maybe building very complex project is lower, because there's so much in AI, for example, that's available off the shelf, or just by paying a cloud provider to power it. You can build very advanced computational products with fairly easy path compared to 10 years ago.
And I think thanks so much for answering this one. I think that's really an interesting thought that I think the new generation of entrepreneurs have versus the previous one. We kind of we tend to look backward and think like, oh my God, how did these people build these technologies? And sometimes I meet people that built businesses a few years ago that look at the new generation and they're kind of like, I have no clue how you do that either. So I think it's
changed. Like the expectations for coders as well has changed. You're used to different way of organizing everything. And PayPal is a good example. I think it was one mono application with, I forget, but millions of lines, and Google is the same. Right? They have billions of lines, I think, in their code base, and they built very complex tools to manage all their deployments. So I think historically, it's easy to go back and think we should have done things a different way. But the reality is that you need your product to continuously evolve, and doing a full rewrite is often not possible or not advisable. I've seen many companies burn as a result of going on, are we going to rewrite everything? It's so much greater now. And then you never finish the project.
This is the nightmare of my technical co-founder. Rewriting.
It happened at Zing, the first company I worked for. We wanted to integrate some IBM web shop to replace our custom-based e-commerce cart. And we never finished the project because we ran out of money and spent probably millions in consultants to help us integrate.
It takes a lot of work to take a company off the ground. And I think I read somewhere that it took you 3 years to finish the MVP, or what you call the MVP of Eventbrite. I'd love to touch a bit on this phase. A lot of entrepreneurs today ask themselves how long it takes to build a great product or get early traction or early product market fit. And it seems like, there was a recent article from Lenny Raczynski where he shows also how a couple of great companies have made it happen. And a lot of these timelines are longer than I would have expected. So for instance, Coda took 3 years to kind of get somewhere. Front also took a couple of years to get somewhere. How do you think about this timeline? Is it like a hunter game? Some people have a really fast time to market. Some people, struggle. Does it take time to craft something well? What's your experience here?
I think in the case of Eventbrite, we found our product market fit fairly quickly. We didn't find our business market fit or the business model that would go with it as quickly. And that was a conscious choice. We wanted to build traction first, so we were totally free. We didn't make any money. PayPal would take a cut of the transactions as the transactions were going through their platform. But we, as Eventbrite, didn't get paid anything until we started testing pricing and introduced pricing basically from one day to the next, slowly reducing the capabilities of the free products until we were happy with the pricing that we had and the drop-off we had in usage. We didn't have much competition at the time, so I think we didn't see that much of people going to other platforms. But still, it's a scary moment where you're totally free and next week you start charging. So that took 3 years to get comfortable with the fact that we had not only decent traction, but also a great business model to go with it. It's much easier to raise when you say we have X% growth, but also we crack monetization, that there's additional revenue growing at the same rate. Versus a lot of startups, I think that, and maybe Coda is a good example of these, that start completely free and over time have to find their niche buyers, some niche users, and then expand from that. The fact that we started first, I think, helped us a lot, and that we built a reputable brand over the years. We manage a lot of money, several billions every year, transact through the platform. So I think that's one key thing that we did better than others, maybe. And Kevin's experience with the money remittance company Zoom that we founded before was very critical in making sure we had no fraud or very little fraud on the platform. And fraud comes as soon as you put a payment link somewhere. So don't think you're going to be under the radar for very long. And you need sophisticated tools to combat fraud in general, but also in building the trust that the money will come, that will come on time, that it will go to the right account, that you'll not dip into the consumer funds to finance your own growth, like FTX. So it's a combination of all that, I think, that helps you build a good case for funds to then back you and helps you grow even faster.
How does it exactly work, this free to paid, kind of transition? When do you decide that growth by all means is not what you need? Like, it seems it was before the Series A, because at Series A, you already need to have a good idea of your monetization strategy. Is it correct?
Yeah, exactly. So I think we introduced payments in 2007, if I recall. So we started the company at the end of 2005, built a lot of the core functionality we needed as a free tool. And then 2007 we introduced the Eventbrite brand. We had a different brand before and started monetization. First by having a paid plan and opting the new users into it by default, and then slowly graduating most free users. I mean, until very recently, free events were free still on the platform. So we decided we needed some flywheel of growth, and that free events were a good way to acquire attendees, but also future organizers. Yeah, that flywheel, I think, worked to our advantage, especially as some accelerating technologies came to maturity, like social networking, mobile phones, etc., that helped us with getting your friends to go with you to the next event.
I really grew up with Facebook and inside Facebook events with basically links to Eventbrite. It was just my whole teenage year, so I can confirm this flywheel worked really, really well.
Same for Meetup, that had their own registration, but it was very basic, and everybody had a separate Eventbrite link to get the payments.
And the pricing piece seems to click pretty quickly, right? You said some of the events were free. If I'm not mistaken, they're still free. If you don't charge, you don't get charged by Eventbrite. And then there was this idea of like just charging when people were making money out of the professional, out of the events they were organizing. Did you? It seems like you really got this secret sauce of pricing almost from the get-go, while pricing is one of the most complex, topic for a startup.
I think it's easier in transactional businesses where you take a percentage of the cost of the item. There's a range of acceptable amounts that you can take as transactions. So I think we got within that limit. We had some complex formula, maybe a bit too complex, for which we changed over time. We had a minimum, for example, on ticket prices, which was a disadvantage for cheap prices. And we had a cap that was quite low, so advantaging the higher priced tickets. Eventually, over time, we ran some tests and adapted it to be more fair across the board. But yeah, pricing is always difficult. Once you have established benchmarks for a specific industry, then you can get into that, and probably you're not far off. But when you sell SaaS products where the value is unclear because you haven't really delivered on your product vision yet, and you're trying to be attractive to VCs who need high ACVs and net or ARR that's very high. So this is a more complex equation, I think, for younger startups to solve in different spaces. That's where you need to be agile. And I see too many companies making poor decisions on their pricing engine and not being able to iterate and learn from experiments rather than intuition and gut feeling.
100%, but they definitely were different directions for you guys, right? You could have become a subscription business where, similar to the cinema.
True.
You have a subscription and every month you can watch a concert or whatever. Or you could even receive, like, I don't know, like a magazine version of Eventbrite. You guys could have become a media. Like there are so many paths for you guys. Like I disagree that it was just an easy choice.
No, it was the most obvious choice, I would say. Win-win. Organizer makes money, we make money, everybody's happy, except maybe the attendee who pays a fee to someone. But we were coming from a world where Ticketmaster and the likes were charging more like 10, 20, 25% of the ticket price as fees. We had a lot of leeway, I think, in providing a much healthier margin on top of organizers that were different profiles because they target much bigger events, and there's a lot more intermediaries in those types of events, each taking their cuts. But our profiles, event organizers, were much smaller, more like repeat workshops or classes. And there, I think we were able to have a fairly good price point for them to use a fairly complex tool in the end. Ticketing always looks simple from the outside, but the reality is quite complex.
It looked quite complex to me. I'd love to talk about the brand a little bit. You just touched on that. It's honestly one of the strongest brand, at least from the last 15 years in tech. And I know you guys put some thought into that because there was this trust issue in the early days, making sure people would put their credit cards. And there was so many scams also on concert tickets. They are still today. How do you think about brand building? How much effort or money or investment did you make on that brand? How much of it was organic?
I think for brand building, word of mouth is very powerful. And at the beginning, we didn't have a sales team. It was all word of mouth, people buying tickets, liking the experience, coming back for their own events. So and to get that, we were answering all the support emails ourselves. We didn't have a support team either, very close to our customers and answering their questions at any time of day. Kevin gave his phone numbers to the first ones that had enough volume on the platform. So I think it's this little gesture that slowly, as you're a team of 3, as you grow into a team of hundreds, you have to maintain somehow. And we were not quite perfect along the way as to how we handle that. I think there were times where it was really hard to get an answer from the Eventbrite support team, for example. We didn't have enough people, or it was staffed the wrong way, or they couldn't answer the questions because they were all new and didn't know the complexity of So this is by far probably the hardest thing to do as you scale up. Maintain that level of closeness that people expect from the interactions they have with your brand to be able to support all these incoming queries, because if you're a successful platform, you'll get a lot of those. And distance between the departments also makes it harder to solve. So I think you need to be very thoughtful about how you build a brand and what does it translate into. Have some clear expectation as to how fast you should come back to customers when they complain. How do you resolve money matters if you're in a transaction business where there are payments involved and payouts in our case? Yeah, the brand building results from that. After that, the cosmetic part, the logo size and fonts and tone of voice and all of that, or I would say additional factors into providing a coherent experience. But the key is trust, I think, first and foremost. Airbnb is a good example of a company that built trust by making radical decisions sometimes of providing large insurance amounts to properties that got destroyed almost by tenants and things like that. They had their own crisis to deal with. We've had many across the years with events, canceled events or hate events. We had a big concert in Central Park that got canceled because of thunderstorms. 50,000 people show up when the event is not happening. So there's a lot of little things that adding up create your brand and make it a long-lasting brand or a brand that disappears quickly because no one wants to trust it anymore.
Very interesting. So basically the brand is what people remember of you when things go wrong more than what...
Yeah. How you react in those situations when things go wrong will be a big criteria for how people judge your brand, much more than whether you use this font or this other font, or even the name of your company. Well, that matters.
I love that. That's so true. And I can't imagine all the craziness that you folks went through. People go mental, for these events when things happen last minute.
Well, especially this is physical, like trying to get into a venue. If it doesn't work, if it's not smooth, you get riots. We had people shot at some of our events in the US. So it's not really our fault. We're not organizing, but you get associated to these tragic events sometimes. You still have to manage your brand reputation during these tough times.
Sounds like hard. Dealing with real stuff, real life stuff, sounds like just in general a very hard situation to be in. And I think digital is like a much safer play for that. You just say people, wait a bit, website is going to be back in 10 minutes.
Maybe. I think there's complexity in digital as well, as Facebook and others can attest.
You wrote, so I'm going to move fast forward much, much later than the early days of Eventbrite to the IPO, which was in 2018, September. 2018. So you IPO the company. That is insane. That is the dream of my co-founder and I, and of many founders I know. How was this day? What's going through the mind of a founder on that day?
In a sense of accomplishment, of course, you've built something that. I mean, the most impressive part is when you see your logo on the New York Stock Exchange as a giant banner. It's like hundreds of feet long and 100 meters tall, I think. So a good accomplishment, I would say. And then the day of, this is like a big party. You are there with all your historical friends, people who've contributed to the success, your investors, your coworkers, your co-founders, of course, if you manage to stay together. And then you reflect on what made you successful. You go through high visibility because there's not too many IPOs every day. So very exciting times. It's also a slow process because you have to fix the price. So this was my biggest surprise. It takes at least 2 or 3 hours to set the initial price of the offering on the floor. So we're all there waiting and they're negotiating in the back end as to what the price is going to be. So it's not a very smooth, like you ring the bell and that's it. You have to wait until that is set and then you open the bell. No, you open the bell first, then they negotiate, and at some point the stock is listed. And then you have all the media attention and all that goes on at the same time. So pretty busy day, I would say, but super fulfilling as a team. But in the end, it's just one day. Right? I think the next day you go back to building, you go back to focusing on your customers. And it's a lot of preparation. It takes months, years to get ready. You have to change a lot of things internally. And then this one day, and then back to normal. Let's continue building. That is, maybe don't put all your eggs on the IPO basket because it's very ephemeral. It stays with you forever, though, so I'm very happy I stayed on. And when you mentioned my 16 years plus of tenure, that's one thing I definitely wanted to go through. The preparation for the IPO itself, and then post-IPO, what happens? How do you manage public companies? How do you change internally as you have to adjust to new reporting requirements, new ways of controlling data, for example? Before everybody has access to everything, and all of a sudden nobody has access to anything. So that makes a lot of intermediary steps that are quite interesting to follow.
That must be an amazing experience. And how do you feel about this whole chapter now? Like, I know you're like a person full of resources and you love to reinvent yourself and you don't want to go through the same journey, but you went through that thing end to end, right? Like it was a fun project with friends. It became this IPO company. So we're reaching the end of the podcast. Renaud, thank you so much for coming. Maybe just one last question. I know you're a person full of resources. This whole story started as a fun project with friends. You folks brought it all the way up to the IPO. There is not much higher in this tech world. How do you think about this chapter? How do you reflect on it? How do you think about the next step? Like, how do you still remain excited about tech after so many years and achieving such a high result?
Yeah, definitely think of it as chapters. So I had my civil engineering career and then my software engineering career. Both of these were about building things. And I'm glad I was able to do that to the extent that of the success of Eventbrite so far. Next chapter for me is about investing, and I've started doing that for quite a while, as you mentioned, as an angel investor, as a venture partner. So now I'm starting a new adventure with other friends. We're starting a fund together, a fund to invest in climate tech in Series B plus, I would say. We're all passionate about the problem of climate change in general and the way technology can hopefully help us by delaying some of the carbon emissions that are responsible for the rise in temperatures. So when we reflected about our past careers and what we wanted to do next, a lot of these logical chapters continue into the next one. And for me, it's about how do I help this company scale up faster? I've done it with Eventbrite, with the few companies I'm on the board of, through my investments as well. So that's my way of continuing to give back to the tech ecosystem. There's a new generation that only wants to work in climate. They know the problem is the biggest of our generation, and same for us. I just had a little girl. I want her to live in a world that's livable, that doesn't require you to move to the Nordics, some country where temperatures are still manageable. And that's the best way I found to bring all these years of experience doing many different things and evolving inside an organization to backing a lot of different founders that have their own dreams and finding the best way to get involved so that we can have a common mission. And I think the mission has always been something that was dear to my heart and that I'll continue doing in the next chapter.
Very inspiring. What is the name of the fund?
It's called Slate VC, Slate Venture Capital.
All right.
I'll make sure founders write the next chapters.
Amazing. I'll make sure I point to this to the website in the description.
Sounds good.
We're reaching the end. Thank you so much for coming, Renaud. It was an amazing chat. Learned many things as usual with you.
My pleasure, Enzo. It was great speaking to you.
If people want to follow up with you or follow your journey or your news, where should we redirect them?
Feel free to email me, Renaud at slate.vc or LinkedIn, Twitter, a bit less these days. Unfortunately, X, sorry.
Yeah, Twitter is a mess these days. I'll make sure I point to you. Thank you, Renaud. It's really a pleasure to have you.
Thank you.
Bye.
Bye-bye.
Thank you for listening to the June podcast. If you enjoyed this episode, please leave us a 5-star rating and subscribe. This episode is powered by June. For a better way to do product analytics, visit june.so.